You've worked nights, weekends, poured your savings into this business, and now your marriage is ending. Am I about to lose the thing I built from the ground up? I'm Hayder Shakara from Melrose Keys Lawyers, and I help business owners protect their livelihoods in divorce. In this video, I'll walk you through the legal process, the traps to avoid, and how to come out of a separation with your business still in your hands. Under Australian family law, a business is considered property, whether it's a sole trader arrangement, a company, a trust, or a partnership. It doesn't matter if your spouse is not on the ABN, didn't work in the business, or never even touched the books. If the business was built or grew during the relationship, it's part of the asset pool. That asset pool is the total of everything you own minus your debts. And just like a house, a car, or an investment account, the business needs to be valued before you can reach a settlement. Now, business valuation in divorce isn't as simple as checking the balance sheet. It's a forensic exercise. We look at tangible assets like property, equipment, and stock. And we also look at intangible assets like goodwill, client relationships, and any intellectual property. Then we assess liabilities, debts, and tax obligations. So you're probably going to need an independent valuer to come in and value the business. And these valuers can use different methods to value the business, depending on the type of business and its income structure. You will need to appoint a valuer jointly to ensure that the valuation is done fairly. There's no point of doing a valuation if one of the parties is not consulted or not part of the process, as they will simply regard it as your evidence and not joint evidence. Also, according to the Federal Circuit and Family Court rules, a single expert needs to be appointed jointly by the parties. That single expert will then create an independent report that will explain how they valued the business and what it was valued at. If you're disputing the valuation report, you could ask the valuer questions after they release the report, and you will also have the ability to put questions to the valuer at a final hearing when the valuer is asked to present their valuation. Once you're in a family law property settlement, there's an obligation for full and frank financial disclosure. This means handing over all the documents that show the financial position of the business. Tax returns, BAS statements, profit and loss statements, balance sheets, loan documents, you name it. Trying to hide information or forget certain documents is one of the fastest ways to lose credibility and get a cost order against you. The courts do take disclosure very seriously, and it has broad powers to investigate if it suspects assets are being hidden. One thing that comes up often is the difference between controlling a business and owning it. You might be the director and shareholder, or you might just run the business operationally. Either way, the court looks at your connection to the asset. If you have control over it and are receiving a benefit from it, even though a trust structure could be in place, it could still be considered part of the property pool. I've had cases where a business was technically owned by a discretionary trust. The other side argued the trust assets were not to be included in the pool, but because the other side had day-to-day control of the business and was receiving funds from the business as if they were the business owner, the court decided they had effective control and the trust assets were included in the settlement. Once the business is valued, the question becomes, how do we deal with it in dividing the assets? There are a few common options. You can keep the business by offsetting the value of that with other assets. For example, your spouse might get a larger share of the property or superannuation, or you might even consider buying out your spouse directly. In rare cases, sometimes people end up running the business together, but that is probably a risky situation that I wouldn't recommend most of the time. In some situations, I've seen the business listed on the market and the proceeds are then divided between the parties in whatever split you've agreed to. We worked with a client who owned a manufacturing company with high fixed costs, and the valuation came back at $1.5 million, but their liquid cash was tight. So what we did was negotiate a deal where the payout to the other spouse was split into 3 installments over 2 years, and it was secured against their property. That way the business could keep operating, could continue generating cash, and the spouse was protected just in case something did go wrong, and we avoided a fire sale of the business. People forget, we're not just talking about dividing assets. Business debts are part of the equation too. If the business has loans, leases, tax liabilities, it comes into account when you're looking at the value of the business. But here's the tricky bit. The court will look at whether those debts are genuine business expenses or whether they've been artificially created to reduce the value of the business. This happens quite often. If they think you've taken on unnecessary debt to lower the payout, the court can adjust for that. Every settlement involving a business has potential tax consequences. Selling assets might trigger capital gains tax. Moving property between entities could incur stamp duty, and in some cases, a restructure of the business could have GST implications. This is where having both a family lawyer and a good accountant or tax lawyer in your corner is essential. Otherwise, you could be stuck with a big tax debt that you did not take into account when you came to a settlement. And this is something that could be avoided, and the debt could actually be split between the two parties instead of just being lumped with one. The earlier you start planning, the more options you have. If you wait until positions have hardened, it's much harder to find creative solutions. Early advice means you can gather documents and explore refinancing or restructuring before you're under court deadlines. If you're a business owner going through a separation, you need to approach it with both a legal and a commercial mindset. Please understand that your business is almost certainly part of the asset pool. Get it valued properly, be transparent in the disclosure, plan for cash flow, and get advice from professionals who understand both family law and business structures. The goal isn't just to survive the divorce, it's to come out with your livelihood intact. If you're in this position, talk to me and my team today. We've helped business owners across Australia protect what they've built while reaching a fair and sustainable settlement. Book a consultation today, and if you found this video useful, subscribe for more in-depth legal guides that go beyond the surface level advice you just find online.